Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
All right, well, welcome to the About podcast, where we explore everything you need to know about your financial health. My name is Jeremy Scott, one of the amazing co-hosts here, but of course joined by my even more amazing and knowledgeable co-host, Roy. How you doing today?
I'm very well. I'm looking forward to our conversation today. It's going to be a lot of content.
Yes. So the days are getting short. The busy season for me is upon me, which is, in the life of a pastor, Advent and Christmas and all of that, is we're definitely winding up into the heavy time of year. And there's a lot of industries, I think, where that's true. If you work in retail or, shipping or anything, this is a big time of year. But you want to talk to us about some things that maybe aren't top of mind for us at this time of year when we're thinking about presents and trees and all that sort of stuff. But it's still important because it's not just it's the end of the year, and that means something in your world.
Yeah, those year-end details. That's what we're going to get into that, and some of the things that people forget about sometimes, and just kind of keep top of mind. And when I work through with my clients, we kind of have a checklist of things we try to cover with people and make sure that they're getting the high-level stuff done. But some of the stuff today is, the client has to take the initiative to do themselves.
Oh, okay.
Yeah, we can't do all of it, but it's things that they should be thinking about that can enhance their overall situation, whether through savings or tax savings or all of that stuff.
Right, because
charitable giving is a big part of that as well.
Right, because it's the end. I mean, the calendar year is also the tax year. I mean, for most people. So there's a big line that gets drawn at the end of the year that says, okay, this is when this is everything you did before now is this year, and then everything else is next year. So,
yep. And this is more about being proactive, because a lot of people don't start thinking about taxes until January.
Right.
February,
right.
of the next year. But let's make sure we wrap everything up for the previous year in December and get that stuff covered so that something doesn't sneak up on us that our CPA yells at us about.
Right. I know in my life and in the life of a lot of, I think, not only churches but also charitable organizations is, our biggest months are November and December as far as giving goes. And I think some of it's a little bit what we're going to talk about today is you're looking towards your taxes and what are those, how do I, tax deductible giving and things like that, is a big deal.
Don't steal my thunder, man.
All right, I won't do it. Sorry, man.
So I actually have a list here of a bunch of stuff.
You do. There's a lot of highlighting on there. I'm like, oh my gosh, this is going to be a long one.
And I don't think it'll be that long, but there's a lot of things to consider doing. And when we're talking about the financial perspective, we'll just start with the things that kind of are high level. Don't forget to do that.
Right.
Make your contributions to your retirement accounts.
Right
Now, if you're doing it through your employer,
mm-hmm.
It might be too late because they take it through your paychecks, right? And they may or may not allow you to change that towards the end of the year.
Right.
But it's just something to check yourself on. Am I saving enough in the current year, and how much have I saved year to date, and versus how much I intended to save, and how does it affect my cash flow, and am I getting that match that they're giving me if I put in a certain amount, or they give me that match? Those things are just really important to pay attention to, but the IRAs more specifically are those things that you can lump money into those.
Right.
So if you're making a Roth IRA contribution or traditional IRA contribution, make sure that you get those done before year end. And I always tell people, just don't push it to the last minute if you can avoid that, because everything gets busy in the Christmas time period, and we don't want that to get lost in the shuffle.
Well, because there's limits to these things, right? I mean, that's the thing. I mean, IRAs and 401ks are different limits, but there's a total amount you can put in there. And so if you find yourself at the end of the year, going, oh, I'm under my limit, but maybe I've got a little extra. I didn't spend quite as much on Christmas presents or whatever that I thought I would, then go ahead and, put it in there so you're not, under the next year. The other thing I found out the other day that you can make is your health savings account. There's a limit to how much you can put into there, but I know mine, several of them, you can put a lump sum of your own money into it if you want to, and that's not a bad place to keep a little bit.
Yeah, depending on how that's set up, the HSA is something that's a lot of time for most people's payroll as well.
Yeah.
You're in a situation where you can kind of control that a little bit more, just how your design is. And some people have that same flexibility, but absolutely get that in before you end. Before we move on, though, from the contribution piece, just to be clear, you do have for your personal IRAs up till your tax filing deadline to make those contributions.
Oh, okay.
Right. But the ones that stop are your 401k or 403b or, the Roth 401k, those things. Because that goes through payroll and, year end is year end. So then the next year's contributions are calculated as next year's contributions starting in your first paycheck in January.
Okay, that makes sense. Well, and honestly, businesses got to do their taxes too. They don't want you lollygagging out there and messing up their reporting and all that. So that seems fair.
But in regards to the HSA savings, right, it's just as equally important on the withdrawal. Yeah. Right. Depending on your medical situation for the year, is there anything that you maybe want to take advantage of if you've met your deductible or whatever that needed to be pulled out to cover those expenses? Right. Those things from your HSA, adding to or subtracting from. Right, just pay attention to that because that is an all-encompassing. It's like a Roth IRA in regards to how you get to spend the money. Right, you put the money in, never been taxed in your HSA. You spend it on a qualified expense, medical. Then you don't have to pay any tax on that money at all. Yeah, yeah.
And I think the other one would be like 529. So you got kids, 529 accounts. Yep. Do you want to put a little extra in there?
Yep. The other one I have here is on the investment world is a pretty big one is tax loss harvesting, right? So
tax loss harvest. This is not going to be as exciting as it sounds because it sounds really exciting.
It's good and bad. When you have gains on things and losses on things, right? Because when we have a diversified portfolio of investments, not everything's up and not everything's down at the same time. So if you have this in a non-retirement account, we call it a non-qualified account.
Okay, so just more of a normal investment kind of account.
Normal investment brokerage type account. Okay. If we have a gain on asset A and a loss on asset B, well, maybe we sell both of those. We're able to offset the loss and the gain, and you kind of reset your cost basis.
Oh, okay. So then, because basically I'm netting out nothing.
Yeah.
Or closer to nothing. Yeah. So I'm not going to pay income tax. So if I in that scenario, if I would say just cash out the thing I made money on, I'm going to pay without realizing the loss, then I'm going to end up paying.
You'll pay a capital gain type thing on it. So we want to try to offset when we can, right? And it's not always that way for people, but if you have any of that, and it's not just in your investment accounts, right? You could have other assets that you have capital gains on, like for instance, clients sold a rental home, big gains on that, and they had some losses in their account with me. That we were able to offset some of it, not a ton of it, but offset some of it.
Every little bit helps.
Yeah. So why not?
Right.
If I don't have to pay the gain on those, in taxes, I mean, why not?
Yeah.
Is really the thing. And you can just sell that asset at a loss and replace it with a similar asset that covers the same kind of risk profile for my clients, that kind of thing.
Got it.
Yeah. So that's important to do before the year end. Let's see here. And I won't get into the weeds on a lot of this stuff, just so you guys know there's more to the tax loss harvesting, CPA, get them involved.
Right.
Make sure we know where we're at exactly before we start moving things around.
Well, I think the thing is if you made some money or if you lost some money, make sure you're taking that into account.
Yep. The charitable donations piece of it is really big for a lot of clients.
Gosh, I hope so.
It's really interesting, though, because they raise the standard deduction for people. So when you give away money charitably, if you don't give above the minimum, you're not really getting a write-off on that like you used to. Right. So a couple things you could consider is, well, I'm going to give all this money in 1 year to be the 2 years of giving.
Yep.
But it gets you over the standard deduction, so then you can write it off, right? Above the standard deduction.
Right.
So that's something charitable giving to consider. Obviously, just getting in your charitable giving is always important. Even if you're not getting a write-off, you're doing it for a reason, right? It's not for the write-off.
There's probably an episode on charitable giving coming up at some point.
I would imagine that as a pastor, you would appreciate that.
I think we should. Well, there was a lot of hand-wringing when they changed the standard deduction about what that was going to do. Yeah. I don't know that I've noticed it's made a substantive difference because I think people give for a lot more reasons than just to get a tax write-off.
Totally.
But
people give from the heart. Right?
It helped. I mean, it helps get a tax write-off.
Well, and another part of that, right, which actually did help with charitable giving in your regard is qualified charitable distributions.
Yes.
Okay, so QCD for short. For our listeners, if you are in a situation where you have to take a required distribution every year, then you can actually give money from your IRA or 401k directly to the institution.
Right.
So, for instance, if you had to take out $12,000 from your retirement account to meet your required distribution amount, and you're like, well, if I take that money, I'm going to have to realize $12,000 of income.
Right.
But I give money to my church every month anyways. So maybe I'll just give from that $12,000 distribution directly to my church. So let's say I gave the church $6,000.
Right.
Well, now I gave 6 to the church, 6 to me. It meets my required distribution amount, but now I only have to realize $6,000 of income.
Right.
And the church doesn't have to pay income tax on theirs, so they get that basically tax-free.
Right.
So I've given tax-deferred dollars that I never paid taxes on to the church or the charity of your choice, and they don't have to pay tax on it either.
Yeah, that's great.
It's a win-win. So that actually really helped with that standard deduction going up for those retirees.
Right.
Because it makes way more sense for them to do that.
Right. Versus if I gave it out of my normal income, then we wouldn't have any of those benefits. Especially if I didn't, if that 6,000 didn't put me over the standard deduction, then I'm not gaining anything, or I'm not getting any advantages there from a tax perspective.
Yeah, it's funny because I have to sometimes argue with clients about you're basically robbing Peter to pay Paul. If you take the money out, the $12,000 goes into your pocket, and then you pay taxes on it, and then you take $6,000 and give it to the church. Right. That doesn't make sense, just financially speaking. If I don't have to pay tax on some of it, let's not pay tax on it because that's what the rules allow.
Right. Exactly.
So, charitable giving, qualified charitable distribution is really important. There's a lot of churches in the community that really like the checks that we send them.
Yes, I'm sure you do.
The 529 piece that you mentioned actually is really important too. You can give basically to those so that, again, it's kind of like a Roth. There's a limit on the amount. Actually, I'm not sure on that. I shouldn't say that because I'm not 100% sure. I don't have the notes in front of me on that specific piece on the amount.
Right.
But I did have to research that recently for a client, so I know there's some details around those things. But if you're going to do it in the tax year, if you are in a state that you live in and you're using the state plan, the state 529 plan, then you can write your contributions off on your state taxes.
Yes.
The state of, for instance, we're in Colorado, state of Colorado.
Yeah. See, we set our kids are all up when we lived in Montana, so they're all in the Montana program. So this year, I didn't think we actually made any contributions in the last couple of years because we did it before. So it was nice there, but now, we still get to do all the 529 stuff with it, and it's all helpful.
Yeah,
in that
you get all the wrap,
but not the state stuff because we live in Colorado now. We don't live in Montana anymore.
Yep,
but
so your contributions, you could open one in Colorado if you still did it, for the younger children, that kind of thing.
Yeah.
So that's important too. Another thing to think about is actually, which a lot of people don't do or think through, but bunching deductions. So if you have a bunch of deductions, right, that you can itemize above the standard deduction,
right?
Well, then do that all in 1 year instead of 2 separate years.
Okay.
So, for instance, that's kind of ties into the charitable piece, right? You're bunching a deduction because I'm going to give my charitable contribution in 1 year instead of 2 because it pushed me above the standard deduction number. That's just an example, but there's other things you can bunch deductions with. But trying to push those forward into 1 year gets you above that standard deduction. You get a little bit more tax saving.
Got it.
That kind of thing.
Yeah.
So that's really a CPA. Like, dig in with them and make sure that, like, hey, is this really to my advantage here?
Right.
But those do make sense in certain situations. We've talked about the Roth IRA conversion.
Yeah, I got a whole episode about that.
Yes, we did have a whole episode on that.
Way more exciting than I thought it was going to be.
You did get into that.
I did. I got really. It was super fun.
So just making sure so that's another thing, right? If you're going to do a conversion, you have to do it per calendar year.
Right.
Okay. So if you're going to do it in this year, 2024, you have to have it done by December 31st.
Okay.
So if you're going to do that, if it makes sense, and some people don't do it till the end of the year if they are active and they have other income sources and they're not exactly sure where everything's going to end up,
right.
They might wait till December because they're like, okay, I have a much clearer picture of where we're at. Now we're going to do that Roth conversion, or we're not.
Got it.
Based off of whatever's going on in their life. So those are really important to get done before the end of the year. Let's see here. Oh, and this is interesting. So I wrote down actually education credits and deductions. Specifically, if you're not aware, make yourself aware of the American Opportunity Tax Credit or deductions like student loan interest. So Google that, folks, if you want to know more about it. And if you've got an education situation going on, we definitely want to take advantage of those if it applies to you.
Right.
So have you ever heard of that one?
I have.
Oh, good.
Yeah. And then does that include the employer, like the employer student where the employees are paying off some of your student loans. I think there's one of those.
I don't remember the details off the top of my head.
There's
honestly.
a couple of them just because, just dealing with student loans, but also last year having a kid in community college and, all that kind of stuff. So, there's some nice programs.
The breadth and width of all this content and of information is so much that I'm not an expert on everything.
No, but I hope people are hearing is like, this is, I think what we're doing right now is kind of a tickle your ear kind of thing going, oh, okay, I think, that's interesting. That might apply to me. Let me go do a little more digging and figure out what are the people in my life I need to talk to about that.
Yep, exactly. Another one. So I have a lot of business owner clients, right? So business owners, right? They want to make sure that number one, everything is in order,
right?
Like, where are my numbers year to date? So I know exactly where I'm at. But then, for instance, this is like the bunching concept again. It's, well, I need to buy some equipment. Does it make sense for me to buy that equipment in this tax year before year end,
right,
to offset some of those gains or taxes or whatever that had this expenditure anyways, right? So it makes sense to do that in this tax year. So get that purchase before year end, so that then that can go on your current year's taxes, claim that deduction,
right?
So business owners are usually pretty on top of that, honestly, because it's such a pivotal piece of their business and their tax savings. But don't forget about it.
Well, especially like large purchases.
The one issue I do have the most is sometimes they're a little bit disorganized. So they got to make sure their books are in order to be able to make those decisions. Instead of figuring it out, where it's in February of the next year, and if we would have done this, that would have really helped us. But we didn't know because we were so disheveled. Right. So having that stuff organized is super important.
I think those small business, especially small businesses that do a lot of end of year stuff, Christmas-based stuff, that's got to even be worse because not the best timing to be worrying about this stuff.
Exactly. Paying attention to that. But, if you're a small business owner, it's kind of like you being a pastor, right? You got to basically manage the church. You got to manage the people. You got to manage the schedule. And some things can get away from you sometimes just because you got so many hats that you're wearing. So that's why we have experts like myself and CPAs and attorneys for those people and individuals as well.
Absolutely.
So the next one is the gift tax exemption. Are you familiar with that one?
Is this for like giving to individuals?
Yes, it is.
Yeah.
Do you know what it is for this year?
I don't.
You can give $18,000 per recipient in the 2024 year. So what does that actually mean? What it means is you have a lifetime gifting amount that you can give personally, right? I think it's actually around $11 million right now, something like that, per person.
Okay.
We expect that to go down. Well, if you gave $30,000 to some Joe Schmo down the road, that is okay. You can do that. There's no taxes technically due on that, okay? But you have to file a gift tax return. Because what they do is they say, okay, here's the lifetime amount of $11 million. Now we have to subtract $30,000 from that number.
Oh, okay.
So now I have, that number, whatever that is,
right.
Left to gift without having to pay estate tax, right? ESTATE, estate. So if you have, and you can give up to $18,000, and it doesn't count towards that.
Oh, okay.
Right. So you could give $18,000 to 10 different people, and that doesn't count towards your estate tax amount.
Okay.
That's really important for some folks who are trying to get wealth to the next generation.
Right.
And you can gift that into, same thing. Like you could put that into a 529 for, your grandkids or something like that, or just an individual account in their name, or however you want to do it. Doesn't matter, but we don't have to file a gift tax return, and it doesn't go against your lifetime exemption.
Okay. That makes sense.
Okay. So that's a really important one to give before year end as well, if you want to count it in the calendar year.
I'm willing and ready and able to receive any gifts up to and including $18,000.
I'm sure
anybody wants to give it to me,
sure
or the church.
Consider the timing of income.
Oh, okay.
So this is another thing that not a lot of people do have this besides business owners or freelance people that are doing work for as a contractor kind of thing. But so you got income coming in this year, and hey, I've had a really great year. Could we maybe push that to January paying me instead of this year?
Yeah, when I used to do some consulting work or a little coaching work, there were times at the end of the year I'm like, I'm just going to invoice for you that in January, right? I'm just looking at the numbers going, I'm going to pay enough already this year. And maybe next year I know I'm not going to have as much work anyway, or whatever. Next year's going to be a down year, so I'm just going to push that into January. That way I don't have to keep a little money in my pocket.
So if you can control that, so whether it's, a lot of times you can't pull it forward, but depending on the situation, maybe you can. And if you can, and you didn't have as much income this year, but you got a lot coming next year because you have your projects or whatever.
Oh yeah. Can I pre-invoice you for something or whatever?
Yeah, just for tax purposes and if that makes sense or not. But that's a pretty big one. Another one is audit protection.
Ooh.
Any idea what that would be?
No, I was audited once and it was unpleasant.
Yeah. Now, if you're audited, let's talk about that. What was the experience?
Well, thankfully we had used a tax preparer, and so she had to deal with it. And actually ended up being her mistake because she had omitted like a 1099 or W-2, or whatever from our return, and we didn't catch that it wasn't in there because it was a small little thing. But it was just enough of an error, that the IRS noticed. Hey, wait. We've got this 1099 that we were told you got, but it wasn't on your return. And then, once you're on the radar, then it was just like, okay. And I was clergy. It ended up being like the second year ever I was clergy and everything like that. So it was a pain for us in that we had to produce a lot of extra documents and sign a bunch of stuff. It was a bigger pain for our tax preparer, for sure, having to do like all that work. And it all worked out. I think we ended up paying a tiny little fee.
Yeah. And the ultimate relief in that situation is just to be organized.
Yes.
So that's the audit protection, is make sure your documentation is thorough.
Yes.
Right? All your I's are dotted and T's are crossed. Good record keeping.
Well, thankfully, we still had the 1099. Like, we had it. It was in the stack of stuff from everything. I'm like, this is in the stack of stuff we gave you, So, I mean, we had that, which was good. We didn't just all chuck it in the trash when we were like, okay, taxes are done.
Yep, exactly. So those things can really help you just make sure that, your financial life and health are in order towards the end of the year, and avoid those audits so that, you're just organized. And you can't avoid all of them, but, if things are organized, it makes your life a lot easier. Like, oh, here's the thing you need, instead of like, oh, where did I put that? Right.
Yeah.
And that's the worst, because a lot of business owners I work with, that's the struggle they have, is just keeping things organized.
Yep.
And then we have the most important that I haven't talked about yet. Is
pins and needles.
If you are of age, you are required to take a required minimum distribution from your retirement account.
You love required minimum distributions.
I think that they are fun to make sure that we don't pay taxes on.
Yes.
Because I shouldn't say taxes, tax penalties on, because if you don't take a required distribution, then you will pay a 50% penalty.
Right.
So if you're supposed to take the 12,000 we were referencing, you just gave $6,000 to the government if you didn't take it. Yeah, it's really gross, right?
Yeah.
So we make sure we take it. So for the clients that work with us, we track that for them. We let them know.
Right.
We try to have all those done before December 1st, so that there's nothing that's going to come up and bite us, right?
Yeah, I imagine that's one of those things that can sneak up onto you, especially if you're in that like 65 to 70 new to retirement kind of age, where you're just trying to figure all this stuff out. There's so much to figure out with Medicare and, and Social Security and all this stuff. I mean, it's one of those things where, I know the RMDs don't start kicking until later. But I mean, you might probably just feel like you got it all figured out. And then, oh, wait, here's this new rule, that you got to deal with. So I get why that's something that gets missed a lot.
And most institutions are pretty good on having that information available to you, right? So even if you're not working with an advisor and you have an account at some big institution like Fidelity or something like that, and they usually give you that information, but it's your job to execute on that information so that you take out the right amount.
Right, you got to be paying attention.
Yep. So for my clients, I calculate that, and I make sure that they know what it is and that we have to take it out. And if they have any charitable inclinations, that's where we use that qualified charitable distribution option available to them, and or they just take it as income because it makes sense for them at that situation.
Right.
But that is hugely impactful if you don't do it. So you got to make sure you do it.
Yeah.
And it's never calculated until December 31st of the year prior.
Okay.
So that's how we calculate the amount that has to be taken out, but we don't know until that happens, right?
Got it.
So some of my clients are like in the first week of the year, hey, what's my amount? I'm like, well, it's not calculated quite yet.
Right.
Give me a couple weeks here to get it all done. So those are the big ones.
Okay.
To make sure that in your financial life, you're doing the things you need to do to try and have the most success, right? We're playing a tax game essentially.
Yep.
And let's play within the rules, but let's make sure that the rules benefit us as much as they can. and not let Uncle Sam take more than he deserves just by the lack of being educated around it or making decisions that could be to your benefit.
Yeah. What I like is there's things in there if you're in your savings years, if you're in your, spending years, if you're in your, child years. I mean, there are things to pay attention to. And it doesn't take a lot of time and energy. It's just pay attention to it, make sure you know what's going on, and you're making, wise choices to set you up, for the most successful future you can have. I mean, not leaving anything on the table.
Yeah, and this may not be all of them, right? I just did a brainstorming session to figure out what I wanted to make sure we covered, but those are the big ones, and I'm sure there's other ones. But if other people have things that we didn't say, definitely drop in the comments so we can educate more people about it if I missed something.
Yeah. I think anytime y'all want to drop stuff in the comments, we really appreciate it. Especially any content ideas or, for us. I mean, obviously this is something we're doing on the regular basis now, and there's a lot of good stuff out there to cover. But and you've no doubt encountered so many of these situations just in your years of working with people. So, but there's still probably stuff out there that maybe isn't on the radar. So, anytime you can drop a comment, let us know what you're thinking or what questions you have. That's really helpful. Yeah,
we'd like to do some Q&A.
Right.
In future episodes, and just based off of people's questions that they have out there, and we'll just drop that into different podcasts and answer those questions for folks. And give a little bit more knowledge on whatever topic they have questions around.
Yeah, because I mean, we're doing this. We're not doing this to make money. I mean, we're doing this this is a community service. I mean, more than anything, and a service to Roy's clients, and but everybody in general. And that's why I was excited to get involved, because I'm learning right along with y'all most of the time, and I really appreciate that.
Well, and it's fun.
It is fun.
Honestly, it's like we're talking about the technology behind this stuff before we started today, and we're just like, wow. There's this, and all these little pieces that you have to put together to make this work.
Well, and it works, and we've had compliments on how good it sounds and everything, which is funny because we're not sitting in a professional studio or anything. No. But it's you do a little bit of research, you figure out what's out there, how to do it right, how to do it well. I mean, and not to stretch it too much, but that's kind of what we're talking about here. Is like, none of the stuff we're using to make this podcast was overly expensive or anything like that. You just have to do a little bit of work to know what you want, what works for you, what you're trying to accomplish. And I think that's the thing you've been pushing with this from the beginning is even on the financial stuff that's probably very intimidating to a lot of us, it doesn't have to be, as long as you know what you want, what you're trying to accomplish, and you're working with somebody, it makes it easier. Of course, you're working with somebody who knows what they're doing.
Well, and like you work with me as a financial planner.
Mm-hmm.
I need to work with you because you just tell me the button to push. If everybody can see all the colors I'm looking at right now on the side, it's a lot of stuff. And if you hit the wrong one, it's like, what is it doing?
But what all the buttons do, it's not so bad. So sometimes we talk about Jesus too.
Yes, we do sometimes.
So this is, like I said, a public kind of service for us in a lot of ways. But we're not the only group that likes to, that engages in a lot of very important public service.
Well, yes.
And I know today's sponsor is one that's close to your heart.
Yes, it is.
I should say sponsor. For those who are listening to audio, that was air quotes on around sponsor, because nobody's giving us anything. But it's
really just a shout out. But the Johnstown Milliken Rotary, right. So they have a passion for youth and cultivating leaders within our youth.
Absolutely.
And jmrotary.org. If you want to learn more about what they do and the impact they make, or if you want to get involved, you can pop into a meeting and check it out. We just had last meeting was Scott Nielsen, the superintendent of Weld RE5J.
Yeah.
Fantastic presentation. We met at the Mad Russian Golf Course up in the old restaurant, which was beautifully renovated.
Oh, I've not been in there.
Beautifully renovated by TRPR.
Nice.
And was fantastic. So shout out to TRPR for also supporting the Johnstown Milliken Rotary, because they were really fantastic to work with. But jmrotary.org.
Right.
Love it. We really enjoy it, and really helping a lot of youth and helping we're actually starting a recycling program at the new Roosevelt.
Nice. Oh, yeah.
Yeah. So we're going to have a can recycling there, and then we're going to have those funds go back into the youth in the local community as well.
And if you're listening from someplace not in northern Colorado and you're like, that all sounds wonderful, but there are Rotary groups everywhere.
Everywhere.
I think that's one of those things that, sometimes people are like, is that still a thing? And I'm like, it very much is still a thing. Different parts of the world, maybe more or less so. And a lot of Rotary groups have that youth focus, to the work that they're doing. I know youth leadership camps and, things like that are things that, kind of exist all over the country. Yep. So I think Rotary in general is something I've learned about recently, is a good organization, and a lot of those community groups. And if it's not Rotary, there is some sort of community group in your community that is trying to do good work in your community.
Yep. So shout out to them. So thank you for sponsoring.
Yep. jamrotary.org. All right, Roy. Well, thank you for this important end of year kind of as we are amidst our Christmas cards and caroling and presents and Christmas Eve services and, all that kind of stuff, that we also need to take care of ourselves and our financial health and all those things and make sure we're setting ourselves up well for 2025.
Yeah, here it comes.
Gosh.
Here it comes.
All right. Well, thank you, Roy.
Thank you, sir. Appreciate it, everybody.
All right. Have a good day.
CWA is a Securities and Exchange registered investment advisor. No content contained herein should be construed as an offer for investment advice or an offer for the purchase or sale of any security, insurance, or other investment product. Investments involve the risk of low loss, including loss of principal. Please consult with a qualified financial, tax, or legal professional before implementing any strategy presented here. Data presented here are obtained from believed reliable sources but cannot be guaranteed as to completeness or accuracy.